metals. Peter Schiff is the CEO of Euro-Pacific Capital and the author of The Real Crash, America's Coming Bankruptcy, How to Save Yourself and Your Country. Peter, good to see you again. We spoke a couple of weeks back, and I think we should start off with what a number of people have picked up on, namely that part of your group, the Euro-Pacific group, but the Euro-Pacific Precious Metals group in particular, has started to accept Bitcoin payments, and a number of viewers have made the point that this, despite the fact that you recently said that Bitcoin was in a bubble, you likened it here on the channel to resembling a modern-day tulip mania, and you said it wouldn't become a source of commerce for the world. So just explain why it is then that you're accepting Bitcoin payments now.
Well, remember, we don't technically accept the Bitcoin. We actually get paid dollars. We've partnered up with a company called BitPay. And so what happens is if somebody who happens to hold Bitcoins wants to purchase precious metals and they'd like to pay for them using their Bitcoin, what they do is they use BitPay, they transfer their Bitcoins to BitPay, and then BitPay gives me dollars to settle the transaction, and then I ship gold to the customer. So I'm taking dollars, but I'm making it easier for people who own Bitcoin to use those Bitcoins to buy gold and silver, which I regard as preferable to Bitcoin. So what I'm really doing is I'm encouraging people who have Bitcoins to turn them into real money.
Still a strong gold.
While we can.
Sure, you're still a strong gold bull.
Yes, despite the recent sell-off, you know, we've dropped about maybe $50 from where we were at the highs last week. And I think a lot of people have jumped to the wrong conclusion with respect to gold. They think the macroeconomic fundamentals are not favorable to gold, and they couldn't be more wrong. We have a real inflation problem. Despite all this talk about there not being enough inflation, there's actually too much, and now the central banks are going to try to create even more. This is a very, very favorable environment for gold. You've got interest rates near zero around the world. You've got governments actively try to destroy the value of the fiat currencies that they're printing. And for people who want to protect their savings, protect the purchasing power of what they have, they are going to be increasingly turning to gold.
I also know, Peter, that you say that people should fear what the Fed is not worried about. Like what?
Well, absolutely. Look, you know, if the Fed is not worried about something, they're not going to guard against it. They're not worried about inflation, and so their guard is down. But I think it's more than that. I think the Fed deliberately wants to create inflation. The Fed looks at inflation as their own get-out-of-jail-free card. They want inflation to bail out overly indebted governments. They want to use inflation to prop up inflated asset markets like stocks and real estate. So since they're going to create inflation, they also want to create an environment where the public believes that inflation is a good thing, so that as they're creating inflation, they can convince us that this is something that we should embrace. Because if we didn't have inflation, we would have the dreaded deflation or lowflation, where the cost of living would go down. That somehow the government is trying to convince everybody that if the things that they need, the things that they want, became more affordable, that would actually be a problem. And the government has to save us from that problem by creating inflation. But they're going to succeed a lot more than they're bargaining for. And the problem is, once inflation really gets out of control, the central banks are powerless to contain it, because the only way to do it would be to dramatically increase interest rates and bring about a financial crisis much worse than 2008. And that's something the central banks don't want to do.
Peter, if I could just push back a little bit on that, if you don't mind. So granted, it's very convenient to have financial repression, and a little bit of inflation at a time when you have heavily indebted countries could be regarded as the least painful way out. But on the other hand, if you look at the near term, where by almost any measure we have negative output gaps, we have relatively weak demand for commodities because of lackluster growth in China, we still have high levels of unemployment, it's kind of tough to see where the immediate inflationary pressures are coming from. So is this something that you see developing not necessarily this year, but 2, 3, 4 years down the road?
No, the inflation is here. I mean, inflation is a monetary phenomenon. It's got nothing to do with slack in the economy or an absence of demand or lots of unemployment. Inflation is the expansion of the money supply. That's where the word comes from. That's what economists used to mean when they mentioned inflation. It was about the expansion of the money supply, the inflation of the money supply. So that's already here, and it's already increasing prices throughout the economy. And in some cases, it prevented prices from declining. But that's still a bad thing. If prices are supposed to fall and the government gets in the way and prevents that from happening by creating inflation, that is still damaging the economy, damaging consumers. And you're talking about, well, we have a lot of debtors. Isn't this the least painful way to repudiate those debts, is to inflate them away? I would argue that that is a more painful way. I think it's more healthy and less painful for the economy if you have too much debt to just default, to just restructure in an honest way, than to try to continue to increase your debt and rely on inflation to wipe it out.
I think we can absolutely agree that inflation is always a monetary phenomenon. I wouldn't dispute that for 1 second. But while central bank reserves have been going through the roof, broad money aggregates have been well behaved because the velocity of money has been declining as fast as reserves have been going up. And you said earlier on that at the end of the day, the only thing that the central banks could do is to jack up interest rates. Actually, they do have more weapons in their closet. They could do what, for example, Asian central banks have done many times, which is simply to make excess reserves required reserves by changing, for example, reserve ratios.
Well, that's also going to have the same effect. You know, you're going to contract credit. Credit is going to become more expensive. But when you have economies that are so addicted to cheap money, when you have the aggregate level of debt that we have in the private sector and, more importantly, in the government sector, anything that increases the cost of credit is going to diminish the ability of governments to service these obligations or maintain the appearance of solvency when, in fact, they're insolvent.
Gotta leave it there.